it comes to raising capital, the biggest mistakes I've seen didn't happen before the raise, they happened because of it. Raising and deploying capital can be one of the most defining or dangerous moments in the life of a company. To really dig into it, I spent over 5 hours in recorded conversations with 5 iconic leaders and investors. Together, they've built and backed companies worth billions, navigated successful exits, and lived through both turbulent and triumphant times. We've woven these conversations together into a mini-series to reveal the patterns and insights you simply can't see by listening to just one of the conversations. Whether you're raising, you're investing, or scaling, these conversations will change the way you think about capital, relationships, and leadership. Over the course of the 3 episodes, you will hear from Mitchell Green, co-founder of Lead Edge Capital, recently ranked the #1 global private equity growth fund by PitchBook, with investments in companies like Alibaba, Asana, Bazaarvoice, and ByteDance. Doug Song, co-founder of Duo Security, scaled it into a multi-billion-dollar cybersecurity company that was eventually acquired by Cisco. Greg Camplin, founder of Redbox, which grew to over 14,000 kiosks and over $2 billion in revenue. He's also the former president and COO of Coinstar. Now he's the CEO of Dentology, which has raised over $50 million and serves more than 60,000 patients. Julie Maple, co-founder of FYRFLY Ventures Partners, and she's a board leader for the V Foundation, where she's helped raise over $100 million for cancer research. And Brett Hurt, serial entrepreneur who founded Coremetrics, which was acquired by IBM. He took Bazaarvoice public, co-founded data.world, which was recently acquired by ServiceNow, and now leads Love Conquers Fear, a purpose-driven venture shaping the next generation of founders. Whether you're bootstrapped, Series D, or somewhere in between, these next couple of episodes will challenge how you think about capital, control, and what it really means to scale. What I've learned is the right capital multiplies your mission, but the wrong capital multiplies your mistakes. Let's climb.
All right, Kirk, we're here for episode 9 of the For You Leaders podcast. Got a couple fun episodes planned here coming forward. We're getting this little mini series baked into the season where we go and use capital as a means of something that we can talk about, but really we're bringing in 5 very special guests in recorded conversations that we can then extract a lot of insights, knowledge, experience from them. And then we can have a little guided conversation here, extract some thoughts from those conversations that you had. So tell us a little bit about the conversations that you recorded.
Yeah, so I'm really excited about this mini-series that we're doing. It's going to be episode 9, 10, and 11. And oftentimes we use big adjectives to kind of describe these people, but I don't think that this is too big when I say that these individuals that I got a chance to interview are iconic investors, CEOs, and just really, really great people. And so I spent close to over 6 hours in 5 different interviews with Mitchell Green. He is one of the co-founders of Lead Edge Capital, which is one of the #1 performing growth equity funds. Brett Hurt, who is a serial entrepreneur, has founded and started companies that have gone public and raised billions. Julie Maples, who started FYRFLY Ventures and is on the board for the V Foundation, has raised over $100 million herself. Doug Song, who co-founded Duo Security, grew that very successfully. You're going to hear some really just brilliant insights from him, and they eventually sold to Cisco for over $2 billion. And then Greg Camplin, who founded Redbox and ended up with over $2 billion in revenue, ended up going on and being the CEO and COO of Coinstar, and now runs and is the CEO of a company called Dentology. And so these 5 people are not just people that we found and asked if they'd come on the podcast. These are friends of mine. These are people that I've gotten to spend time with, to get to know, and more importantly, to learn from and build trust with. And we're going to hear about those things. So we went into this, with the purpose of talking about raising capital, how to deploy capital, how to build that trust with investors and that relationship, and what do good, healthy boards look like. And we came out on the other side with so much more. The conversations kind of took on a life of their own. I'm really excited about stitching this together with you and us getting a chance to just react to this, but really letting them take center stage. Many of our podcasts up to this point have been you and I, and the one with the family, which I absolutely enjoyed. But we're taking a little bit of a twist here and saying, let's go out into the world and find out from people that have lived this, done this, and have made a huge impact. And you have done a remarkable job pulling this together. I mean, you really have. This was no easy task. It was absolute spaghetti, because it's 6 hours of interviews that you went through and have really built a story that I hope our listeners get something from. I hope that they get a chance that there's one idea that they get, or like an aha, or like, I thought that was right. And I really hope it does add value to them. I hope they're willing to share it with somebody that they think it could help, because that's really what this whole season is about. As we get, there's 12 episodes in this season, and this is 9, 10, 11, and then we'll have 12. And then we're going to put a bow on this season. And my hope is this piece of this mini-series that we're doing really speaks to those out there that are raising capital, that are deploying capital, that are growing companies, and that are making choices, and they don't have to spend IQ points solving problems that have already been solved that we're going to talk about. They can spend IQ points growing their business instead.
Yep. Oh, I mean, just to touch on a little bit about what we've done this season, we've really focused on that messy middle of scaling a business, right? I want to ground today's conversation in that it's easy to get pulled into the details of raising capital. And as someone who is in a business that's venture backed right now at sustainment, and we're getting ready here at some point to open up our next round of funding, getting to listen to these interviews for me and getting to go pour over them and layer in AI to help extract things out of these conversations. And then now I get to sit here and talk with you about them, well in advance of when this episode goes live. I feel very fortunate, going through Mitchell and Julie and Brett and Doug and Greg. I mean, their expertise is incredible. And then getting to sit with you and the conversations we have not on camera, learning about these things is really helpful for me. So thank you for the opportunity. I really appreciate it.
Absolutely. And if people have not figured out by now, hopefully they have. But if this is the first one they're listening to, you're my son-in-law, and that is not why you're doing this. You're very talented at what you do. I've had so many people that have watched the podcast that said, wow, he is really gifted at what he does. I think they actually are enjoying you more than me, which I love. That's awesome. And you really are gifted at this, so I do appreciate it.
Oh, well, thank you. That's awesome. Well, for today's conversation, I want to set the tone here. We've broken this out into 3 segments. And so we're going to be playing clips. We've got 16 clips in today's episode that we're going to start with. The segments that we're going to go through, there's first, defining the valuation trap. And this is really just about talking about, it's not just about how much you raise, but how you raise, the terms, the expectations that follow. So our guests, ironically, I think that you've had some thoughts you've already poured out in this season about how you raise money and how you run the business to go raise money and kind of put fuel on the fire. The guests really, this was one of the topics for me that was really fascinating about how they all kind of said the same thing and they didn't know it.
Yeah, they were separate interviews.
Really fascinating.
Separate days, separate interviews.
Yeah, they didn't realize that, they didn't know that the questions were similar in some ways and different in others. And so, it's really fascinating to hear how much overlap there was.
Yeah, that's a good point. I didn't have 32 questions. I asked every single one of them. Everyone was just its own standalone, unique conversation. And to your point, how they answered some of those questions, even used some of the exact same words. I was like, wow.
Well, some of them even referenced one another.
Yeah.
Which I think is super fascinating. You're going to hear in these interviews that they'll even say, oh, the success we had with, so-and-so at this company. I don't want to put any spoilers out there, but it's really fascinating. And then, so the first one, defining the valuation trap. Second, learning to exercise capital discipline, really talking about what it looks like to run the business as if you hadn't raised whatever that number is, especially for those businesses that do get the opportunity to raise a lot of money. And then the last one is the value of a self-aware founder, entrepreneur, and investor, and what that can do for the business. So that's the table for today. I'm going to be clicking here, running clips. We're going to be responding to each of these clips, just kind of giving a little bit of insight or clarity. But more than anything, our goal is not to try and outshine these, because really, there's so much expertise in these clips. The fact that there's so much expertise actually requires us to go stitch together these clips to tell a story.
Yeah.
And so that's the goal of today's conversation, is that we just want to bring in all of their expertise into one facilitated conversation here, have a little back and forth and go through this. But hopefully this is helpful for our listeners. I do want to remind you, though, if you want to go and learn more from each person, we are going to release bonus episodes, the full conversation with all 5 of our guests.
Yeah, between me and
episodes. That's correct.
Yeah. And I don't know if it'll make sense for you to do this, but as we transition to each one of those, it's really good. And I really want to double down on what you said for that last piece of today, is the value of a self-aware founder, entrepreneur, and investor. Seems like a bit of an odd title for something, but hopefully you're going to get something from that and why that. Once again, these are not things that we went into the conversations. These are things that got pulled out of it.
Yep.
Right? I mean, this was the gold that was like, wow, didn't expect that. That was great.
Well, we heard it from both sides, right? Some of these people are in the operator seat. Some of these are in the investor seat. Some of them do a little bit of both, which is really fascinating. But we tried to hone in on the things that were very consistent across the conversations and allowed us to tell a consistent narrative.
Yep.
All right, well, let's get into this first segment here, defining the valuation trap. We're going to start with Mitchell Green. Got a clip from him where he talks about the biggest trap when it comes to raising capital.
Don't get blinded by valuation is probably the most important thing. The highest, headline numbers, aren't always the best deals. Sometimes it's coming with terms that are impossible to meet without distorting the business. Sometimes it has like very onerous downside terms. A clean deal at a lower price, we always say is almost always better for the entrepreneur over the long run than a complex structured deal at a much higher price. Now, why is that? Entrepreneurs are always optimistic. That's why you're an entrepreneur. Yeah. Of course, like if I say if I'm doing 15 million in revenue this year, like of course I'm going to do 50 million in 3 years. Maybe you don't. Like, and so, and I think it's when you have a really, really high valuation, you set a very high bogey for yourself. And so I think it's actually like you want your investors to make money as well. And I know we'd say keep it clean. It's just much easier. And so, like if I were advising my son or daughter, I'd also say like, again, don't just ask about the valuation, ask about how are you going to help me? Who are you going to introduce me to? How are you going to help me find my next head of sales? How are you going to find me my CFO? How can you get me how can you help me get, my top 10 customer targets? By the way, additionally, I want to talk to a couple of your entrepreneurs where it didn't work. That's actually more important. But it's just funny, like for us, if you go ask Doug Song at Doing Security or Brett Hurt at Bazaarvoice or Chris Capriano at Toast, like, of course they're going to say great things about us. The companies, we all made a ton of money together. But actually, you want to go talk to the companies that were like 1Xs or even lost money in. It's like when times get tough, that's actually how you want to really see how people behave.
All right. So Kirk, tell me a little bit about what Mitchell was meaning here when he said clean deals versus, highly structured deals at different valuation points.
Yeah. So there was a lot of depth in what he said there and kind of to get underneath it, essentially, and simply what he's saying rather than getting a higher valuation, and oftentimes, like anything that has more risk and more complexity to it, there's going to be more terms and things tied to that to hopefully mitigate the downside risk, right? And doing those things. But what he was saying in there also is sometimes taking a clean deal that is straightforward at a lower price or at a lower valuation. What's the value of the business? So someone's going to put in so let's say simple terms, business worth $1,000, and they're saying it's worth 10. We're going to give you $100. That's worth 10% of the business. And so rather than saying, well, no, it's actually worth $5,000 or $10,000. So now your $100 it doesn't reduce the equity that they take in the company. And so there's this tension between getting the highest number of what the value of the business is versus the money that you're going to take in. Sometimes that's just a piece of the puzzle where you've got to say, I'd rather take a lower price, have somebody that's going to help me find my CFO, somebody that's going to actually, that does when times get tough, because there's never ever been a company that did not hit tough times. What happens inside that relationship? What does that look like? I want to talk to some people that have actually you've been in that arena with, that it hasn't gone well with. And so looking at that complexity, and what he's saying is sometimes and you'll hear me talk about this, it's kind of like going out and taking a mortgage on your house. You've gone down in the market study, your house is worth, $500,000. And you go get a mortgage saying the house is worth $3 million. And everyone calls you and congratulates you. Congratulations on the huge mortgage you just got. And that's kind of what happens when you hear these congratulatory, like, oh, you just raised, $10 million or $100 million. But you just made it where now you got to make that house worth $3 million in a neighborhood it'll never be worth that. And that's what he's trying to say. He's saying you put this complexity and this weight on the business that and we're going to hear more about this as we get into these conversations. And so that's a little bit about what he's talking about. Is you're wiser to look at this and see, take a lower price, get a cleaner deal with not a whole bunch of what you'll hear is like kind of hair on the deal, meaning that complexity of different terms, preference, which we'll talk about, those kind of things.
Mm-hmm. So basically what he's saying, it sounds like, is that valuation is not the only like top determining factor here. You should be factoring in kind of the relationship, the resources, the willingness to participate, and what that gets you. Is that kind of what you're saying?
Yeah, and I think what he's saying is be realistic about what the value of the business is. It is what it is, and like I said, there's this tension between not wanting to give more of the business away, the equity of the business where the value is, but I've seen more times than not where giving away more with the right people, you end up with a better outcome. And all your investors make money, including your common shares, which are typically your teammates and your employees. They get it. I've seen where just there's preferred stock, and there's common stock. Preferred stock is coming out first, and then common is after that. And I've seen where the preferred have made money, but the common have not. And that's what he's saying is you don't want that. You want everybody to make money. When he says investors, he's saying everybody.
Well, it's a great segue, and I don't know if you realized you were setting that up,
No.
but Julie Maples, this next clip we're going to play, she kind of talks about the idea of liquidation preference overhang and getting through the pref stack into common and all of that. So let me pull her clip up here. We'll go on over to Julie.
When the valuations get set too high, the runway is only X long, and you're really setting yourself up for a down round, which I try to, just share my experiences with that. Not only my experiences, but my experiences with other founders who, in their startups, when the later stage rounds keep extracting more and more, it hurts the founders as much as it does the seed stage investors. So I try to explain that there's a lot of alignment where I am and, the founders are. And then I give them experiences, or I give them other founders that I've worked with that will share their stories of the painful down rounds. So hopefully there's some balance at the end of the day where they're achieving something they're really happy about, something that works for our ownership expectations at our firm, and something that's setting us up for success for the next round. And I think that's key to really be set up for success in the seed stage round. More often than not, we're winding up doing a secondary tranche of the seed. So sometimes it's a flat valuation. Sometimes it might be a slight step up in valuation, but we're deploying more capital in the seed stage round, in this decade than we had in prior. And it's really because you got to set them up to achieve those milestones to go into a successful Series A.
All right. So that was Julie. Tell me a little bit about what she's hitting on here, in maybe for some of our listeners who are kind of newer into raising capital. Explain down rounds and kind of just the stigma that comes with that.
Yeah, so Julie Maples is a remarkable person, first and foremost, but as somebody that does put venture money into companies, she is the kind of caring soul that you want that is actually going to help you. And so what she's saying there is she's saying that a down round is, it's a seed round, which is what it sounds like. It's an early on round. And then there's A, B, and C, just, following the simple alphabet. And so in those earlier rounds, the valuation gets set. And sometimes those get set way too high because maybe there's not revenue, maybe there's some IP, maybe it's really a unique opportunity. Maybe it's a serial entrepreneur that's done this 2 or 3 times. And so they're able to maybe, require a higher valuation, what they're saying the business is worth, going back to what I said earlier. So if we raise it, saying the business is, keep it really simple numbers, $1,000, and as Mitchell was saying, of course they're optimistic. You're an entrepreneur. That's why you're an entrepreneur. Today I made, this year we made 15 million. Of course we're going to make 50 million in 3 years. Well, if we get to 3 years from now and it's time to raise again and we've only made 20 million, and not 50 million. So now the business isn't worth that $1,000 that we said it was. It's really worth $750. So now you're raising on what's called a down round. You've come down from the previous valuation. And that's what Julie's trying to say, and that's what I think Mitchell was saying. I think we're going to hear this echoed through this, is the investors that you end up with, you want them to care about, once again, helping you launch and succeed well. You do not want to have to, I'm telling you, I have sat with businesses, it is the most miserable thing when you have to make the business worth something it will never be worth. And sometimes, as we talked earlier about, TAM, the thesis, the execution, or TEM, excuse me, execution and the macros, sometimes I've seen businesses that were growing and had huge, $600, $700 million valuations, and the market changed. Their thesis wasn't wrong and their execution wasn't wrong, but the market changed and it contracted. And now their revenue fell off the table and they're trying to raise it a down round, and no one's going to make that money. And that's what they're trying to say early on. Let's build this thing. And I think you're going to hear this story throughout this, and that's what she's talking about.
Mm-hmm. I'm glad you brought up TEM model, the thesis, execution, macro. Go back to the first 2 episodes. There's a ton of resources, and that's where we really hone in on that model and that just that curve of how we gauge growth for the CEO. 2 great resources in that episode. Let's go to the next clip here. Brett Hurt shares a little bit about Bazaarvoice and data.world, some learnings from there.
The ideal fundraise, for sure, the nirvana state for a company raising capital is when they truly do not need the capital except to grow faster. Like, that's the state that Bazaarvoice hit within its first year of existence. And because of that, we went from 0 to 100 million of AR in 6 years, and we only raised 23 million and had 13 million left in the bank when we went public, right? So, Y Combinator said it was one of the top 3 most cash flow efficient SaaS companies of all time. That's a nirvana state. That's super duper rare. The majority of the time, you're raising capital because you can predict that you're going to run out of money.
So there's a lot in there. First, before you kind of dissect Brett's thoughts there, tell me a little bit about your working relationship with him. I know you've been specifically with him for a long time now.
Yeah, so Brett and I have worked together 15, 16 years now. I met him when they very first started working, or started Bazaarvoice. Worked with him and his team through the IPO. And through data.world. Remember when they very first started data.world with him and his co-founders, built that up, recently sold it to ServiceNow, and now he's started something that's really spectacular. In fact, he's got a podcast coming out, Love Conquers Fear. And so Brett's a very soulful, brilliant entrepreneur. There's a lot of things that I've learned from him and have built, what I tell people is, and this is what I most enjoy about what I've been able to do over the years, is it starts off as a business relationship, but it almost always typically ends in a friendship. I mean, a real friendship, where we know each other's families and those things. And so Brett's a friend in that way.
That's awesome. Dissect a little bit for me. What was he speaking into it? I know he said a lot in like 45 seconds there and shared a lot of experience as well.
Yeah, so what he said is, Nirvana at Bazaarvoice, it was incredibly unique. Part of it was, just being able to be behind the scenes, how they set up their contracts, how they collected money in the front end, not in the back end, and how they built that product and a service that was spectacular and really added value, obviously, to their customers. But in the ideal world, you're not trying to have to raise money to just cover operational costs, but it's really for growth. And he did say that. The ideal is being able to raise money where you really have a line of sight, and here's how we're going to grow. Here's how we're going to expand product lines, or here's how we're going to expand geographically, or here's how we're going to grow revenue. We just need capital because we need to go hire more people. We need to build better, processes and systems or something like that. We need to build the machinery, people, processes, and systems that will unlock that growth versus we're going to build it and hope this works. That's not really, and that's unfortunately what happens a lot of time. I've had CEOs that have said, hey, we're getting ready to raise this round. They were hot, things were going well, the money was accessed, and I said, I'm going to encourage you not to. You don't have the team that is ready to deploy that capital. So you're going to bring this money in, you're going to get pressure to spend it, you're going to be handing it to people that aren't necessarily capable or experienced on how to go to deploy that capital, and you're going to tear through it. And then you're going to be left. I mean, it's going to be exciting in the beginning because you're going to be attracting really, good investors and stuff like that. But your team is not ready to deploy this. So that's what Brett is saying. Like, do it when you're ready to grow. But most of the time, for most people, you can predict. What he's saying is predict. That really key word. That means you've got the systems and processes that are able to accurately see what's going to happen, and you know when you're going to run out because you've got good discipline, you've got a good team and stuff that can predict that. It's not like, hey, eventually we're going to run out, but it's truly, and you're going to hear more about this, where it's saying, here's our processes and systems. We know when this is running out. We know that it's a 9-month runway to be able to raise this capital to get the kind of investors, and so you start that process ahead of time because it's actually part of your routine.
Mm-hmm. No, that's great. I mean, I don't want to steal thunder, but there's a clip coming where Brett shares a bit about his vision for raising capital at the right time. And we've got a whole segment here about exercising discipline with capital. So you're hitting on a lot of great things. The other thing that I thought was super interesting from that, I did not know that Y Combinator had labeled that as one of the top 3 most cash flow efficient companies, in SaaS, that's high praise from Y Combinator.
And this may not be right, but I think when we were going through it, when Bazaarvoice was going, I think it was the number 1. I think.
That's wild.
That might not be right, but I remember it was.
I've had so many people in the Austin community, as I've gotten entrenched into that through sustainment, get to spend quite a bit of time down there. I'm remote here in Fort Worth, but inevitably make my way down to Austin quite a bit. But a week doesn't go by where, Bazaarvoice doesn't come up as an example. And Brett's name is, in a lot of conversations with people inside and outside the company with a lot of high praise.
Yeah. No, it was. I felt very, very lucky to be part of that journey. It was really fun. I mean, it was really fun, and get to see some of the decisions made, like I said, so how the cash flowed into the business. Once again, it wasn't just that they had a great product or service, they absolutely did, but they were also very thoughtful about, obviously, capital discipline, but once again, contractually, how they set those things up and how they collected cash and stuff like that to get ahead of it. So they were raising internally. Essentially.
Well, it sounds like what made it fun too is it wasn't that you hit the highest mountaintop ever. And he kind of talks about the money that people made, the return on the investment. And you go look at a company like Facebook and how much larger that number is. So it wasn't necessarily that this was the largest company of all time, but the way that it was run.
Capital efficient.
Yep. All right, well, we're going to stick with Brett. He's got another really good clip here, so I'm going to pull this up. Talks about pref stack fragility in this clip.
A lot of these headlines that you've seen over the past 3 years in the post-ZIRP era, ZIRP stands for zero interest rate period, where SaaS valuations hit an all-time high from a multiple perspective, the multiple of the amount of revenue they had to the amount they're raising at. Like some companies were 10 million of AR and they're raising at $1 billion of valuation. Most of those companies now deeply regret that because they never grew out of that hole. Those companies, when they got that $1 billion valuation, a lot of times they were taking it at a 3, 4, 5x participating preferred, which means that all that capital that they're raising, 100 million, 200 million, if they're raising at 5x participating preferred, it means that they need to clear $1 billion on the pref stack. If they raise 200 million, it's 5x of that, just to even get any money back to common. So that's a really, really, really hard scenario. And nobody talks about that in these headlines.
So, I mean, I'll let you speak on this, but you kind of hit the nail on the head earlier with your mortgage analogy here, but go ahead and feel free to weigh in on that.
Yeah, just briefly, that's a big part of the reason we're doing this podcast series is what Brett just said there is there's a lot underneath that it's not in the headlines that you don't see, and it's that messy middle that we've talked about. And I've walked that lonely journey with people that have clinked the glasses of champagne with that valuation, only later to sit in isolation and feel very lonely about the decisions they made. The preference, like when he's saying people have 2 or 3 times preference. So once again, you're saying your company's worth $1,000. I'm saying I'm going to give you $100, but I want 5x preference. That means that you have to pay me back 5 times my money before anyone else gets theirs. And sometimes people just, I'm sure this is a totally appropriate word choice here, but people have said it, and it's stuck with me. They just get so horny for the money that they just don't really, they don't make good decisions about, how's this going to play out? I mean, I think consistently you'll hear through this, and hopefully this pulls through, is I'd rather have a business that's healthy and I can grow and I can make sure everybody's making their money and I, can push it than I would rather than having, I'd rather have 15% of a company with the right people around the table than 30% of the company with the wrong people and the wrong structure.
That's really well said. I like that a lot. All right, well, we got one more clip in this segment, and we kind of put some final thoughts to defining the valuation trap before we move into capital discipline. Going to go back to Mitchell Green here, and it uses the term party rounds and talks about what it's like to have messy cap tables and what that does in the business.
Yeah. So a messy cap table is like a silent killer. It might feel like a win early on to just, take checks from tons of small investors. We call it like the party round. You take a round where there's like, you raise $50 million and normally you'd have like one investor do 45 and then some people do like, the existing investors who do the follow-on would do like their pro rata. But instead you don't get one investor to take 45, you get like four, get like four investors to split the 45. That's called a party round. That's like, we also refer to it as a low conviction round. And then at that point, years later, when you're trying to get something done or sell the company or raise more money, you have all these investors with like different voices. So, some of them are at different prices, misaligned incentives. Investors all have different agendas. I just keep it simple. Yes. If it's a rocket ship that when you invest is 10 million and it goes to 300 million and you paid a reasonable price, then it's not going to matter if you have lots of different series and different structures and everything like that. But like most companies face a hiccup at some time.
There's a lot in there. Yeah. Feel free to kind of just dissect it how you want.
A couple things. I know we're using like ARR, cap table. And like so people that maybe aren't familiar with this, ARR is annual reoccurring revenue. That's a SaaS model. People that are familiar with that obviously know that cap table is short for capitalization table. That means those are the people that are on essentially your spreadsheet, their names, and what are they, kind of what part of the business they own. It's called a cap table. That's everybody that's own it and their relative ownership. And so simply, I'm not going to add more to what Mitchell said because I think it was pretty clear. Like, don't make it complex. If the low conviction group, what it means is just everybody's in for a little bit, but no one's in for an amount that's really going to, be overly distracting to them. I mean, those sound like big numbers, but for some of these people, they're not going to miss a meal because of that. Essentially is what he's saying. At the end, most companies hiccup at some point. No one ever, I've never heard anybody plan for that. I've been doing this for 30 years. I've never heard anybody say, well, we're going to hiccup, so we're going to plan for that. Now, they may have thought that and built that in. I get that. But to his point, you'll hear others, hopefully along the way, they're going to say, it just always happens. You hit a hiccup. And that's when the complexity and that's when the weight of how you structure the deal gets felt. It's not the day that the checks clear the bank. It's the day when you need more checks.
No, that's exactly right. I mean, this was not planned, but I was going to say, companies probably don't plan to go through the gap.
Yeah.
You've drawn in previous episodes, right? But a lot of companies go through the gap.
Yeah,
right?
Absolutely.
And so I think that's what he's trying to get at here is that you should almost, and he actually does say this in a later segment, but he says, you should prepare actually for the worst to happen and have a plan for that. I think there's a lot. That honestly is a clip that I thought about. Does this belong in the defining valuation trap segment, or is this more of the capital discipline, which is why I kind of put it at the end and then start, because it kind of fits in both buckets.
Absolutely does. No, it's, it's, once again, I mean, there's so much wisdom in just this little piece that we've already heard here, and there's going to be more that gets drawn out here, and hopefully people will stop, pause, go back and listen to what they're saying, because there is a depth there. Like, why would they say that? Keep saying, asking the question like, why would they say it's more complex, or why is that nirvana? Why is raising up, or what Julie said about why are they carrying this around? Like, ask those questions, and this may be some of the episodes where people do want to reach out even more to us and say, hey, can you give a little more clarity to this, because there's so much weight here. We could, like I said, I've interviewed for 6 hours. We're going to spend another 3 to 3.5 hours doing this. There's 10 hours, we can make this 20 hours at a blink of an eye, and we're not going to do that. But.
Well, and bringing these guests in too, I mean, just to highlight this, your total number of billions of dollars of exits that you've helped oversee the growth of, right, by investing in the leader of the company, is over $17 billion over the last 30 years. And we're kind of like starting to peel the layer back on some of who these actual people are.
Yeah.
Right? Like they're real people, real relationships that have real life experiences. And that's what this is really about, is letting you hear directly from these people. And this is, I mean, you won't say this, you have a lot of humility about you, but I will say it. This is literally just the tip of the iceberg of people that you've impacted and businesses that you've come in and helped grow to successful valuations, successful exits, not just at the number, but in the way that they got there and the type of business and the type of leadership it took to get there. So, I mean, kudos to you for doing that. And hopefully our listeners get a piece of that through this interview as well.
Well, thank you. I've learned a lot from the people I've gotten to come alongside. I'm standing on scars. And once again, I wish there would have been someone that could have come alongside me when I was going through it, that they were standing on scars. And that's really what this is about. So I really appreciate saying, and these, like I said, the trust that has been built with these folks allowed for these kind of conversations. It was a lot of fun for me. It was like a walk down memory lane for me too. So it was really fun.
Well, I can tell you it's helpful for me. I guarantee this is going to be helpful for others to hear. So.
Good.
All right. Well, that concludes first segment. So defining the valuation trap. Any final thoughts before I move on from that? Just kind of how we would put a bow on that.
I just think that they summarized it really well. It's, I think the thread that kind of pulls through for me anyways, and maybe it's just my experience, but it's what I heard here too, is, be wise about, the valuation. It can be very seductive. It can feel really, really good. One is you're not giving up as much as your company. It's a big number. It's going to, you're going to have a PR release about it and everything else like that. But you got to go and make that $500,000 house all of a sudden a $3 million, $5 million house. And then you got to look around and say, well, no one around in the house here has the ability to do that. So I got a clean house. That's no fun. And it's not going to be in this neighborhood. So I got to figure out how to pick this house up and get it out of this neighborhood and make it bigger. I mean, that's, maybe not the greatest analogy, but I think it makes sense. Like, that's what you have to do the business. It's like, I don't have the people that have ever grown that size of business. We don't have that market. We don't have that product. We don't have, and all of a sudden, something that was a great and healthy business became very unhealthy because of a couple strokes of the pen and poor decisions.
So let's move into exercising capital discipline. Get to hear the first two clips here from Doug's song. This first one here I'm going to pull up is the 12.
And Doug was one of the co-founders of Duo Security.
Yep.
And is just a brilliant leader.
I think people will hear that from his clips here. This one's on 12-month post-money rule from Doug's song.
Well, the way I like to think about it is, I know, generally speaking, right, in our startup community, we like to talk about finding investors that are founder friendly, right? Or, but we've also kind of veered, frankly, into a world, particularly after, I don't want to name any companies, but there are so many now where the founders have been not just beneficiaries of friendly terms, but they've kind of almost held sort of their investors hostage, right? To sort of what they've been doing or wanted to do in this kind of bubble era of like free capital or prior. So I think for founders, constructively, raising the right amount means trying to actually meet your expectations post money, maybe within 12 months, not 18 months or 24, right? Everyone talks about you raise for the next 24 months and, of what you're going to do or 18. But for me, as I talk with my my old CFO, Paul, about all these things, is always about trying to meet that within 12 months. That, just keeps the numbers easy, particularly if you're a SaaS company, on a traditional kind of 10x revenue multiple, you want to grow into that ARR to justify your post money within 12 months. And it's very, very basic, the simplest kind of math to sort of work through, but it's also how you sort of literally beat the odds, right? And show that you're achieving sort of uncommon sort of velocity and valuation growth in the business for what you do next. Because, after that round and after you've spent the money, you either, need to be raising up or need to need to raise money.
So walk me through a little bit about what does Doug mean? And maybe for listeners who don't know the terminology there, what does he mean by 12-month post money versus kind of what the standard status quo is?
It's just saying, 12 months, you should be able to be at that runway rate, meaning the revenue that you're generating should be able 12 months after you raise that money. Sometimes people are trying to raise enough money to get out 18, 24 months. Some people say raising money, so they want to try to get as much as they can, which is, I understand and get, but he's saying from a discipline, and he said to kind of beat the odds, because to some degree, this is playing the odds, right?
I love that phrase.
Yeah, exactly. And so to think that it's not is not wise. The other thing he says, talking to his CFO, Paul, who was a great leader, great CFO, he had someone on his team that he was depending upon to kind of help be realistic in their predictions of what 12 months from now, what they would be doing run rate wise, revenue and expense wise, and are we raising it at that level that we'll be able to actually hit that number. Now, you may put more money in the bank that's going to take you out longer, but he's saying at 12 months, we should be able to be hitting that, because once again, it's going to cause us to be more disciplined. We're going to have to be closer to the truth. We've talked about that a lot on this podcast. Keep moving closer to the truth. Sometimes it's uncomfortable. It doesn't feel good, but keep moving closer to 12 months versus 18 or 24 months. Post raising, after you've raised that money, keeping it to that 12 months, it just keeps you crisper, sharper, more disciplined. If it gets out a little, it just becomes a little bit more unrealistic too, right? You get 18, 24 months, it's like, yeah, that's out so far. Like, we'll get there. But it's like, we got to hit this in 12 months, and you really have that discipline and that tone, what I call that tone from the top inside the business, and you operate it from that, you create a higher and better accountability, cleaner and more clear communication. So once again, as you said earlier, it isn't just the number and the $1 billion exits and all these other stuff. It's like, how are we constructing this underneath this to happen? And that's what Doug's talking about. That's one piece of just good, healthy discipline that puts the odds mostly in your favor.
No,
to behave that way.
It's really well said. One thing I like about this too is that the underlying theme, the thing he didn't say, is using discipline as a way of working towards efficiency. And he didn't point to AI as the way of getting there, which is like how we're almost being trained as humans right now, is to think efficiency. Okay, I got to figure out how to go to AI. He pointed to Paul.
Yeah.
Pointed to a CFO, and he said, I've got a running mate that I know and I trust, and that we align, our values align, and we're going to help one another to make sure that we run this thing the right way. And I'm sure that they leverage AI in ways to do that in the day-to-day. But at the end of the day, they're elevating the thought leadership of two great leaders within a company who trust one another and are pointed to the same thing to go out and beat the odds, like you said.
Yeah. And once again, I was fortunate enough to sit, at the elbow of these people, and I know that there are name brand venture capitalists that wanted to put money into Duo, and because of their disciplines, and we're going to hear about those in other areas, that discipline, that they said no to those folks. I mean, and these are iconic kind of folks, and I was also able to be there. They had someone that was willing to buy them for $1 billion, and they went into the journey with them, but at the last moment decided that because of the things that they felt were possible and what was possible with the business, they ended up saying no to that offer, and went on to sell it to Cisco for several millions of dollars, and it's been a good relationship for both Duo and Cisco since then.
It's awesome. Let's continue the conversation from Doug, picking up about 15 seconds later in the actual interview to kind of hear the rest of his thoughts there. Couple minutes on this clip here.
It's also horizon of planning that you can actually, sort of navigate with your team. If you're talking about like 24 months, it's hard, right? In startup land, it's 2 years out. It's hard to anyone to guess at. But within 12 months, you can make concrete plans for what that looks like, and be assured that, again, the capital you're taking, you're going to be in a justified place, right? 12 months from now for having raised it. And so that's my guidance. Again, it's not the popular thing maybe in a time where folks have always raised so much more money than they've ever needed. And to be fair, your other question was about sort of like when the right time is to take the capital, right? Like I say, because we had that opportunity. We didn't need the money, strictly speaking, right? But we always found kind of the opportunity, right, to go and take it on to go faster. Quite frankly, we're technically shy of 120 million raised. I think 119 million we ultimately raised. We only spent 14 of it to get to 100 million ARR, and ultimately to get to 200 million, we spent less than 40. And so, did we over raise? Maybe. But, the later rounds were reasonable terms, right, for us to take effective our mezzanine rounds en route to our IPO. And we were looking at some other larger strategic things that we would do with it, an acquisition or two ahead of our IPO that we would have done. And this is a scenario that I had talked with one of my other friends, Jeff Lawson, the CEO of Twilio, another set of Michigan founders who ended up building a pretty significant company. At one point, the hottest or sexiest stock in the world, apparently. He was on the cover of Forbes with that title. I thought that was pretty funny.
Yeah.
But he had also tanked up about 100 million cash on the balance sheet as he was also looking to, tuck in a company or two or really learn the process of strategic growth through acquisition, but not strictly in the public eye, right? Building those muscles, getting that done first as a private company before you'd have to do that as a public company. And so that was really the goal for the later rounds we took that we didn't use, but we got acquired instead. But sometimes, investors can be preemptive about this. Certainly from our A to our B was a little bit that, Benchmark came calling. We didn't expect them and found them pretty exciting, honestly, to consider working with. It was a very different point of view on how to build businesses that we didn't think about. And then, Redpoint came in also preemptively, but these things all were sort of introductions from, our prior investors that had worked to, again, could help continue to lever the company up with more and more strategic capital.
He mentioned public versus private companies, and there's certain expectations that come with each. Walk me through, before you go and try and expand upon anything else he said there, walk me through what he meant when he was talking about that building from private before they would go public.
So there's a whole process to going public, as you might imagine. I mean, the strategic investors that you get around you, the team that you have got to get put together, people that have been there and kind of have done that, both, from just different C-level executives in the business. And so as you get ready to go public, there's a whole series of things that you do, probably a good 12 to 18 months ahead of before that even happens. And so they were in that journey. They were going to go public, and then Cisco came in and bought them before they went public. And so that's what he was kind of referring to is they raised a mezzanine round and they started getting themselves prepared to go into the public markets, only to be purchased by Cisco.
So
does that answer your question?
Yeah, it does.
Okay.
So basically that there's certain disciplines in that track that are required is what he's touching on there.
Yeah. And they were in that journey when Cisco came in and purchased them before they went public.
Right.
One of the things that we're starting to hear now, right? Doug was talking about, I think he said they spent 14 million of the 119 million that they'd spent to get to 100 million in ARR. That means annual recurring revenue. That means every single year that's what they're making. And before they got to 200 million in ARR, I think he said they spent 40 million. But they had, he said maybe we over-raised. When Brett talked about this, how they were capital efficient, they had the right thesis. What was our right to win? Wasn't just they had a great product and had a really great definition of what their ICP is, their ideal customer profile. They had the right thesis. They had excellent execution. They put the right people on the team that actually, when they called the shot, they made the shot. That's what he's talking about, 12-month post, people that could actually do that math and do that hard work and think through that were standing on scars and could be predictive in doing those things, people that could actually bring products and services to market and price those correctly, customer success people that could actually answer, and make those calls, all the different pieces and parts that go into making the machinery work, and they were in a good market. They had a good market. So that 10, that thesis execution, and that's why that is so critical. And that's where we started off this whole podcast series in 1 and 2 talking about that. Same thing with Brett when he was talking about Bazaarvoice. So they're talking about this capital efficiency, which now they're using capital as a strategy. You heard Doug talk about. We're able to bring in investors that had a different point of view that we hadn't thought about. They were preemptive. They came to them. Those investors came to Duo or came to Bazaarvoice. And it was because of what you heard him say, because other investors had made those introductions. You see the relational pieces that are starting to come together here has really very little to do with money. Money is like anything else. It's a tool. It's a tool that can be used like a chainsaw to brush your teeth. Not the way to use that tool. Or it can be used to chop down a great tree and create a path towards something beautiful. And so if you tune your ear to these things, that's what you're starting to hear is they were capital efficient, but then they kept on taking on money because it brought the right people around the table. I'd rather have less ownership of my company with the right people around because I know I'm always going to end up with a better outcome. What Mitchell said, don't make it as complex. What Julie said, get it right in the beginning. Take people on that care. I mean, that's what we're starting to hear and hear built here. Not just capital strategies. I mean, these are strategies, but they're not the kind that you typically think about.
One of the messy middle aspects too that I hear in that is just how on this journey of raising capital from the headlines, right? The headlines makes it seem like, wow, if you raised, 500 million, 200 million, whatever it is, $1 billion, you must have, VCs and private equity firms and stuff out the wazoo just waiting to get on your calendar. And the reality of the CEO and the founder basically, doing the road show and going and pitching the business to so many different people and just the toll on the founder, on the CEO in that process. I mean, I'm sure you've seen quite a bit of that.
I mean, you get pulled out of the business. I mean, it is a good 6 to 8 month distraction where you just aren't able to run the business like you would otherwise do. And that's why these things are so critical, because it's pulling you out of what needs you is the business, but the business needs this oxygen, this capital. And it's
so critical to have the right team in place too, because the second you pull the leader out, people need you can't have everything kind of that rake organization.
Exactly.
Houston, we have a rake. If everyone is rolling up to the CEO, and then the CEO for 8 months needs to basically be on the road pitching the business to go get more capital into the business. I mean, that's a problem. That's a real problem.
Yeah. And that's, I'm glad you called that out, because that's when I see one of the big times when I see a rake organization that's really problematic.
Yeah.
Because that tone from that top, that kind of galvanizing glue that keeps things together, which should be the team, shouldn't be an individual. I mean, early on, sure, but as the business grows and you're out raising this kind of level of capital and stuff like that, everybody's got to be playing their part.
Yeah. Very different seed round, Series B, C, and beyond. Kind of what you're able to accomplish with how many people.
Yeah,
for sure.
And that's honestly that's why this first 6 or 7 episodes, 8 episodes that we did in this was kind of talking about having some of those things in, because we know that this is going to be a piece of this raising capital, whether you're doing it going to a bank, or you're going to venture capital, private equity, or something, or you're doing it through raising it with your customers. Honestly, the disciplines are not significantly different. How they get deployed and how you think about using each of those different tools is different. But if you don't have that execution piece of the TIM model, if you don't have that execution piece, that team and that ability to do that and stuff like that, once again, I've just seen more poor decisions be made that are reflective of not having that. And so it's not you have this one and then you get this one. You're oftentimes they're in parallel, and it's never a perfect balance. You're always working on it.
Yeah. Well, and one delineation too I want to make just as a umbrella statement before we get to Greg here for the next clip is that, we don't want this episode or these next 3 episodes to come across as capital as ultimate, right? I think the reality is that capital is inevitable, and it comes in various forms and shapes and sizes, right? Capital could be taking money from friends and family. And we talked about that in earlier episodes. It doesn't have to just be taking capital from a leading venture capital or private equity firm.
That's very true.
And so this is not to make that ultimate. I mean, my dad, he gave me an example, and I was telling you this recently, that he's been able to do things, without going to venture capital or private equity for his 3 businesses that he runs. And he's had some pretty good success doing that. And he walks away with the ability to have more ownership in the company, which, that will never make the headlines, right? But it does create resources, and it does, getting to see the inner workings of that, I can see why that's lucrative, right? And why that is special to him. And so this is not to say, hey, let's train people up to learn how to raise a lot of capital and be good at doing it, and running effective teams. This, for some people, you may hear this and say, gosh, maybe I'll just try and bootstrap this thing, or maybe I'll try and keep this thing as close-knit as possible. And that's not a bad outcome for some people. And I think Mitchell, at the end of his interview, that's actually what he left his interview off with, was saying that some people this is not, it's not for them.
Yeah. And once again, it is a tool. And I think hopefully people hear, whether it's your dad, it's me, it's others that have raised or don't ever raise a dime, don't ever even use a bank, and everything in between. It's about, what are you putting around you? Who are you putting around you? What systems and processes and people are you building around you? Because you are going to need capital, whether you're a not-for-profit or you're the largest company on the face of the planet. You need to, access and deploy capital one way or another.
No, that's a
And
great
so
call
that's so we're kind of going down one vein here a little bit, but don't. I hope it's not lost on the people that are listening that there's some things that are tangential to this that are true in every single situation.
Great call out. I mean, in a short statement, it takes money to make money.
Yeah, exactly.
In a really short statement.
Yeah.
So the money's got to come from somewhere, and in a lot of cases, it comes through raising capital. And like you said, even nonprofits, understanding how to build a donor board, right, that believes in you and gets the vision, right, is important, versus who will give you the highest dollar amount.
Yep.
So, all right, cool. Well, let's go to Greg. Excited to bring his clip in here. He talks about cash and viewing it as a precious commodity.
Getting a lot of capital at high valuation is not always the blessing it seems. If you get a big infusion and it's at the top of the market, and by the way, a bunch of companies were at that place just 2 or 3 years ago, I think it's fine if you recognize those things and you say, hey, we should all be really happy that we just got a phenomenal valuation and a lot of money. But let's be honest with ourselves and say it probably was an overestimation of where we are in most markets. And let's not act as if we're flush with cash. Let's act as if it's a precious commodity, because markets change, and sometimes really fast. And I've been through enough cycles now, starting with .com, to know that money dries up really fast. It's sometimes startling how fast it does dry up. And if you act like it's always going to be flowing, that's a challenge. So I think you need to have the approach of, yeah, we got great money and great valuation, but let's behave as if money is going to be much harder to come by in the future, and preserve that capital as long as possible.
I love listening to Greg and just his stories scaling Redbox, which obviously there's been a huge change in how even Redbox would operate. When he started, I think it was 20 years ago.
Yeah, and he left long before it was still on the rise when he left after he founded it.
That's right.
Founded that. It was over $2 billion in sales. So keep going.
Yeah. So walk me through. He talks about treating cash as a precious commodity, and he even called out discipline directly. This is one of my favorite clips that came out of this episode specifically, because it talks so directly to the point we're trying to make here. But tell me a little bit about what you remember with Greg, being in the weeds with him, and then kind of what he's trying to describe here at a high level.
A couple things he said is, that's great that we had this valuation. Let's be honest with ourselves. We can fool everyone else. Let's not fool ourselves. We're probably not worth that in most of the markets. Let's be real. That's getting back closer to that truth. He said markets, that part of the Tim, the markets change really fast and cash dries up really fast. And so if we're going to assume that's always going to be there, once again, it just creates, if you push that to its logical conclusion, if we think that cash is always going to be there, we just operate a little bit softer. We're not as tight in how we make decisions. We maybe spend a little bit more on that offsite than we should. Maybe we spend a little bit more, maybe we let someone sit in a seat, a little bit longer than is productive, even though they're not really producing. But I've seen what happens when the cash dries up, and all those choices, when the cash is now gone, and you can't claw it back, then all these decisions are made. And we see where there's rifts, reductions in forces, where there's, that when we get into that gap, that's where we better really know what happened. Was it because the market dried up? Was it because, our execution isn't which is usually about 90% of the time, it is execution. It's typically not a bad thesis or market. It's usually execution. And so what Greg is saying there is just operate, even even if you're in a growth mode and profit is not the number one thing, at least have a discipline and act like that's what you're trying to get to.
Mm-hmm.
Because I hear people, oh no, we're growing, it doesn't matter. I understand the sentiment, I understand the statement, but operate as if it does matter. Operate like this is your money. Operate it like it's the money for your kids' college. Operate like it's your parents' money. Whatever you've got to do to operate with discipline and respect, which we're going to talk a lot about as we keep going in this. And I think that's what he's saying. This is somebody that has been the CEO of companies that have been wildly successful that's saying this.
Mm-hmm.
This isn't somebody that's raised 1 or 2 rounds or something like this. Is, multi-billion-dollar companies that are saying, let's be honest with ourselves. Markets change. Let's have discipline around cash. It's precious.
Mm-hmm. Yeah, there's a lot in there to unpack. And I love what you chose to hone in on. And I also love that you tied it to very specific things, very specific examples in the business, but then you also went into personal examples too. And kind of what I hear in that is, there's a difference in people who live paycheck to paycheck versus those who just, the money's kind of flowing in. And if you were to truly analyze the spending habits of those two households, they probably look different. And the term you would use to describe the difference is discipline at the end of the day.
Yeah. And discipline to what, right?
Yeah.
So it's not just being tight-fisted, but it's discipline to what? It's like, what are the outcomes that we're going for? Every CEO and their team makes promises and sets goals. Promises to themselves and their family, promises to their investors, promises to their customers, promises to the team that's there to help deliver on this. And then they set out about achieving those promises and keeping those goals. So what is the discipline? And this is where I said I've just seen people get too horny for the money, that the discipline or what we promised, ultimately discipline is to the promises. I've seen where the promises have been like, that sounded good at the time, but I didn't really mean that. It's like, all right, you've just opened up Pandora's box. Let's see what's inside.
Well, you got to get closer to the truth, like you said. And one of those core things to be running at is value. At the end of the day, how are we in a value creation stage? And there's going to be different markets, different times where that's easier at times and harder at times. And to give you an example at Sustainment, one of the things that we do that, to give you kind of a feel of like not being tight-fisted, like you said about things, we're a remote first company. We do try and hire in Austin when we can, but we have a very forward model, and we tell this with our candidates of hey, we value in-person collaboration. So yes, we are remote first, but you can expect to fly to Austin or drive to Austin depending on where you live, because we get work done when we're in the presence of one another. And when we go sit at dinner and you get to ask questions, hey, how's your kid doing? How's the dog? Oh, you're moving? Where are you moving to? And you learn these people. You build real relationships with the people that you work with, so that when you go back to your remote environment, which the flexibility is great to have, we get more done, and the value that comes out of that is higher ultimately. So that's one of those investments that we've made, that it costs real money to fly people in and stay in hotels, especially in Austin, and spend the time out of all of our schedules. You probably could, quote unquote, get more done, from home. But I think the value you create in getting people together is really, really high.
Yeah. It's kind of funny that you say, it's a whole nother podcast probably, is you say we can get more done at home. I'd say you don't get as much done. I think you're working at home. So I'm not saying the remote, but I'm saying who's the measure of that? And all I'm saying is I'm saying that investment and spending that time and that human touch, we were wired up to be in community. We were wired up to know and be in each other's lives. Some people are more outgoing and they need more of that than other people. I get it. That's the spice of life. That's what's beautiful and wonderful. We're not all the same. Thank goodness, or we couldn't go to our favorite restaurant because everybody'd be there, right? It's everybody's favorite restaurant. But the point being is that investment, it costs real money. What we don't know is what's the cost of not doing that. And that's my whole point I'm trying to make here. This isn't about working from home or not. I'm not talking about it. I'm just saying it is a very wise investment. Einstein had this sign hanging over his desk when he was at Princeton that said, the things that matter the most in life can't be measured. And I'd like to believe this is one of the things you're talking about, is that investment that you're talking
That's a
about.
great application of that. To tease the next episode, episode 10 is all about after the raise, the relationship, the communication. And so I think that there's probably some dynamics at play there as well. All right, one more clip in this segment here. We're going to go to Brett Hurt talking about raising your hand and raising money before you need it.
For me, I always raised capital at data.world at least a year before we'd run out of money. That was super important, and that saved our bacon in many situations, including the meteor that hit our business that we couldn't have predicted, which was the pandemic, the COVID-19 pandemic, which I really was in a very fearful state for a while, that may be the blow that knocks us out of business and, bankrupts the company. But then, I got Prologis Ventures, one of our customers, Prologis, huge company, to invest. And that created the cascade of, wow, even customers are investing. And then we were able to raise enough money to survive and thrive and eventually have this exit to ServiceNow. So most people say, wait until you have 6 months left in the bank. That's way too stressful for me and not ideal. But that is more the norm. And I've even gotten that advice on, the board of both, data.world as well as other companies that, hey, don't worry about it until you have 6 months of capital in the bank. But the problem with that is that if you really get down to the wire, then you get very desperate on terms. And I was able to have data.world throughout its entire history raise at a 1x non-participating preferred pari passu to all prior rounds, so that everybody was rowing in the same boat.
Walk me through a little bit about what Brett was saying there and maybe also, touch on, is that the norm, right? He mentioned 6 months kind of being that window. He looked to raise a year in advance of needing the money. Walk me through the process there.
So a couple things. One is he talks a little bit about, and remember, Mitchell said at the end of his little clip that it said everybody hits a hiccup. He's talking about, COVID-19. We've talked about how markets shift. Greg said that in his, they shift quickly.
It's more than a hiccup.
Yeah, exactly, right? But I'm saying, once again, I want you to get everybody to kind of hear these threads that are kind of pulling through. But what Brett's talking about there is, I don't know if the norm is 6 months or not. That's kind of what I think he said a lot of people do. I know most people usually 9 to 12 months are just getting pretty serious about trying to find it, because it's just 6 months is a little bit close. Usually it takes about 6 months to put a round together that's meaningful and get the right people and stuff like that. But also, market timings too, right? I mean, if you're hitting some quarters and they're going well and stuff like that, that tells a better story than we haven't hit a quarter in 6 quarters, That doesn't tell a great story. You're going to be looking at a down round if that's happening. And so, but I think, he's probably always, weighing more than just the calendars on the month, knowing Brett. But that's one that's a signal of like, hey, if we're going to be out in the next, we need to be looking at this. But I also watched Brett operate. He's also 15, 18 months out of that, he's pushing his team saying, all right, here's what we've got to be doing. Here's what we've got to be hitting. Because I know that in this time, so I'm going to start having the conversations with the right people in order for me to be able to go and say what I need to say in order to be able to raise the capital that we need to continue to grow and be successful. These things have got to be in order. So he may start going out externally 12 months, but he's probably 15 to 18 months ahead of that, starting to say, team, if we're not doing these things, here's the things we got to get in place.
It's really
so it's probably a longer tail than even 12 months.
Yeah, so a discipline of staying ahead, planning, and it sounds like having systems, processes, and people that can help you actually identify with truth to the matter what is 12 months, right?
Yeah.
What is 15 months? Understanding that pathway.
Yeah, exactly, and understand what does that mean? From a standpoint of just what's our monthly burn, what's going on with our pipeline, meaning how many people are we bringing into it? What's our churn, meaning how many people are kind of, do we have a leaky bucket, meaning do we have customers that aren't staying for whatever reason? How do we fix that? Once again, it comes back to that execution. The tighter that is, the more we can move towards this strategic money, right? The money that we want to be able to have better terms with the bank, better term with the venture capital, better terms with the things that Doug was talking about, or Greg was talking about, or Julie was saying. You know, those are the things that move us closer to the truth and closer to that strategic money. The further you get away from the truth, meaning valuations that aren't real, we're not really executing, but we don't tell ourselves that. We don't really have the right people in the right spots. You know, we're in the gap, but we don't really recognize it. We keep on moving further, and that's why I want people to be close to it. The further we move away from that, the more likely we're going to take non-strategic money just to survive, and that's the beginning of the end. And that's not me saying that. They've said this.
Absolutely. I think all of our guests have done a great job making that point. I'm going to use that to pivot into our final segment of the episode here, the value of a self-aware founder, entrepreneur, and investor. We're going to go over to Julie with some thoughts on what it looks like to be extra self-aware and extra thoughtful.
I think it's really having, the sort of self-presence and self-awareness that there is a time that you slow down before you speed up. And it is getting to know those people, getting to know the investors, whether it's an angel or a seed stage fund or a later stage fund, ask for the references, do some checks around, and really understand how they've worked with companies. Or, if it is somebody you're expecting to make introductions for you, see that they've done that for other companies. A lot of times there are other investors on the cap table. And even though I'm the seed stage investor, they may be a Series C or a Series D, and we never hear from them. And it should be, there may be a likely relationship that they're opening up that door, and that's not happening. I think other things that I've seen done really well, again, is a current founder who really took the time to understand what each constituent on the investor syndicate was bringing to the table. And sometimes it was not at all, but that was the expectation that was set. So really understanding what each component is. And if you are going to take in angel funds, you're really understanding what each one of those tranches of capital or pockets of capital are going to be. And also know that, there's a high probability they won't be falling on in a later stage round. So ensuring that this seed syndicate, right, knowing that are those seed stage investors saving capital, saving powder if there's a secondary seed, because oftentimes there is, we haven't hit all the milestones. And so it's being really thoughtful about all the elements of the round.
So let's dissect that. And one note I want to give you is that we do have more clips in this segment than the last. So we'll tighten up kind of our feedback on each of these so we can get through all of their clips. But what does Julie mean when she talks about being extra self-aware here?
I think she's just saying do your homework. Like really understand, one, not just who you're bringing in, but what is it that you need, and pattern matching those two. Like who's going to provide those needs? I think a common mistake is we just assume that people bringing in money are going to do whatever they can to help, and not everybody has a complete tool bag of what they can do to help. And so be clear about what you need, and be clear and do your homework, and have them meet each other. Create a community. Don't silo this up. Don't just think this is access to money. This is access to a whole world of networks and other people. And that's what she's saying about being self-aware. Be awake. What do you really need, and who's going to provide it?
And looking beyond just money as a resource. Yep. Awesome. Yep. All right, let's go to Brett here. Brett talks a little bit about investing in other entrepreneurs from his own learned experiences. Really cool clip here.
So, if you have that awareness, if you're like really have that deep communion with your soul, then you'll realize that $1 billion valuation is purely a act of ego. There's no other explanation for it. And it could be an act of ego that really is the doom of your company. And so, you need to look, it's like anything else. You need to come up with a fair deal for both parties. Like the best investments are ones where both people are going to make a lot of money under different scenarios. And that's, that's what I'm always trying to do. Like, I'm very proud of the fact with Bazaarvoice that people made, anywhere from 70 to 110 times their money. I mean, that's kind of an incredible thing. People put 100,000 in, made $7 million to $1 million. That, of course, it wasn't like the biggest exit of all time. I mean, it was $1 billion IPO. And as you said, it won different awards for that, which is great. But, there are people that invested at the beginning of Facebook that made like 3,000 times their money. Like that's one, Jason Calacanis, who recently moved to Austin, always likes to brag about Uber, where he put in $100,000. And I think that netted, $100 million or something like that. So, there are those examples. I haven't had one of those yet. We're investors in a $130 a little bit over 170 startups. And we're in the seed round for what are now 12 unicorns, which is fantastic. I mean, that's like a huge home run for us and a home run for those entrepreneurs. But I was just on a trip, as you know, in the Grand Canyon, and the organizer of that trip is a very good friend of mine. And he's been in the seed round for now, what are 42 unicorns, right? So,
Wow.
So it's incredible. But you know, the main thing I am is an entrepreneur, and that's what I like to do the most. The investing stuff I do on the side is more to help other entrepreneurs and the karmic benefit of that, and also just the intellectual curiosity of lots of different levels of impact in different industries. And you know, I've learned so much through investing in other entrepreneurs, and I'm there to help them when they need a shoulder to either cry on, or they've got a big opportunity, or, you know, board member not working out, or whatever it is, because I almost never serve on the board of directors. I'm only on one for-profit board of directors today for Lincoln Brown's company, who's one of my best friends, and I'm really passionate about that company. So I stay very disciplined in making sure that I can be literally someone not in control of anything for them, so that they can just completely be transparent with me about things either melting up or melting down.
You obviously have a lot of experience with Brett and in those companies, and understand kind of what he's talking to here. Walk me through those dynamics, and what can our listeners take away from that?
You know, we heard the word discipline again, right? Discipline. I'm invested in over 40, probably 50 now, different companies, and you do learn something. And you know what I want people to take away from this is once again not the big numbers and the opportunities. It's like, yeah, of course, you know, if I could do that, I'd want to do that, or whatever the case might be. What he's talking about is what he has learned and continues to learn. He's always in a posture of learning. Brett is somebody that cares deeply about trying to share those experiences with other people. He's never said this, but it's always been something I felt about Brett is he's like, if I can do this, you can do this too, type of thing. And so he's always trying to share in what he's done, what he's learned, and doing those things. And so the entrepreneurs that he's invested in, and people that he hasn't invested money in, but he will invest time in, is endless. And so it's just, here's somebody that has, like I said, not only been part of billion-dollar exits, but has invested a significant amount of money, and is still kind of talking about, like, don't let your ego get in the way. I mean, everyone's saying, don't you have to have some ego? We're going to talk about that.
Let's go to Julie here. Really quick clip from her. I just thought this was cool coming after Brett's clip. You'll see why.
And as soon as you're pushing those boundaries of maybe you achieve a step up in valuation, but then you're vulnerable to the liquidation preferences, right? And that's purely going to hit the founder or the early investors. Brett Hurt has always done an amazing job navigating and balancing, you know, distributions over all of his partners. He's done a really good job on holding that line and getting transactions done that are kind of magic. So it's not an easy dance. But if you start out from the beginning with a more rational valuation, you're in much better shoes than if you don't.
So obviously cool from a couple angles. One, validating everything Brett just said and the experience and the relationship there. But there was something she said there at the end that I saw you nod at. I mean, what struck a chord with you there?
Well, a couple things. Just as I'm hearing these people, I'm just remembering so many of these conversations, and so it's like it's taking me back down memory lane.
These are real life experiences. That's what I love about how unique this episode is. That I don't know that our listeners will get is that these guests. I mean, these are not like people that we reach out to through a friend of a friend. I mean, these are shared experiences that you know very well and we're in the trenches for. So.
Yeah, well, and like I said, and they weren't sitting next to each other. We weren't all in a room together, and she was looking over at Brett. I mean, these were like literally, I mean, I think it was like weeks apart so for her to talk about Brett or Mitchell talk about Doug or whatever the case may be. Anyways, a couple things that she said there is think about the beginning. And the reason I was shaking my head there is she was saying, Brett has a long-term view. He knows that the first round is not the only round. He knows that there's an exit and we're going to build towards that. And so he knows if he launches wrong, he's going to land wrong. And that's what I heard her saying. And it's true. And not just Brett, but for anybody. And so those valuations and stuff like that we get so excited about in the beginning and stuff like that, build the right team, because they are going to be the ones that are going to help you win.
Mm-hmm.
They have access to see what's going on in the world and around them. And when those hiccups hit and stuff like that, they are going to be the people that are going to pull you through. But if it's that uncommitted money, that party round that we were talking about and everything else like that, you're going to be dangling in the wind at some point, because they've got a portfolio of people that maybe didn't start off wrong and have raised wrong. They maybe have a Duo in their security. They maybe have a Bazaarvoice in their, they may have a Red Box in there. What are they, they've got to go with their winners. They've got LPs. They've got customers too that they've got to serve. You're not the only game in town.
That's a great perspective.
So do it wisely from the beginning.
Yeah, that's a great perspective. Puts this in light of the bigger picture. Part of being self-aware.
Yeah, that's right.
All right, let's go over to Mitchell. Been a minute since we've heard from him. Let's talk about what it looks like to be disciplined as an investor.
If you think about it, our time and entrepreneurs' time is the most valuable thing. I think one of the biggest problems that investors have is they don't tell people no fast. I also have a problem with that with institutional investors and funds too. It's like, just say no. Like, why do you want to meet me 3 times? It's a waste of your time and my time. I think it's actually because a huge amount of people in this world just want to keep their jobs and appear to look busy so they can just show up and collect a paycheck.
I totally agree, Mitchell.
They're not actually on a mission for anything. And no, I don't want to tell you that I don't want to invest in your business, but I'm going to tell you that just so we don't waste my time and waste your time. And I think it's the guys at Sequoia get a very tough rap on this. I think they're just look, we know what we're looking for and we ignore everything else. And ignoring is just hey, it's not for us. Sorry. It's just, and for us, it's very criteria driven. It's, does the company meet 5 or more criteria? Yes or no? If the answer, no, again, how do you go from 900 down to 150 to 175? I mean, simple. Is the market size big enough? Oftentimes the CEO may not want to do anything, but let's say he wants to do anything. So then how do you go from 150 to 175 down to 5 to 7 deals a year? Simple. Customer references. Does the data actually say what you said it did? How do you reference as an entrepreneur? Did the market size check out big enough? Oh, by the way, was the valuations reasonable? Can we hit our target returns based on the valuation that you want to do a deal at? Good company and good investment are 2 fundamentally different things. And so, we have a high cost of capital and, we win our fair share, but we definitely lose up some. And, by the way, to be clear, the best deals, if you just say what are your biggest mistakes at Lead Edge? It's not the stuff we invested in that didn't work. It's the stuff we didn't invest in because we thought it was too expensive. By far. But those are by far our biggest mistakes. That being said, we're still going to continue to operate in the exact way we do because of, we've avoided so much garbage by staying super disciplined.
Just for clarification, so people understand, he's talking about going from 900 down to 170. He's talking about the number of deals they look at in a year and how much they actually end up funding. And so that's what I don't know if that was clear in that, what he was talking about there, but he was saying, how do they do that? It's to this discipline. They have the set of criteria that we're going to talk about. He gave some of it in here, but I would go through once again in the full interview and I ask him, what are those criteria? And he gives what those are. And you have to meet 5. I think there's 9 total. They have to meet 5 of those 9. And they just won't. And I think the Ted Williams quote, what he's talking about is, you know better than I do. You're a baseball guy. I was top hitter, and he could have hit more home runs if he hit stuff that was out of the strike zone, but he just wouldn't swing at it. He would only swing it, and that's kind of what Mitchell's referring to, is they only swing at stuff that's in their strike zone. And he said the biggest mistakes we've made, or the ones we said no to because we thought they were too expensive. But guess what? We're going to keep doing it because we keep winning. We keep swinging and things are in our strike zone, and it works. I mean, once again, how do you get to be at least in that category of number 1? Probably hit things in your strike zone.
Well,
discipline.
It's such a good analogy. I am a baseball guy, so I'm glad you called that out because I am going to dive into that.
Yeah. See, you'll do a much better job of it than I do.
No, I think you did it really well. I think one of the parts that goes when you hear a quote like that of he hit so well, he had a high batting average. That was the statistic that he was measured by. It'd be like in football, you have a high completion percentage, right?
Yeah.
And so, because they hit the slants, the quick slants, right?
Uh-huh.
It's nothing different than that. But that's a very obvious statement. You'll appreciate that as a football guy. You know, if I just go tell a quarterback, well, hey, I mean, you just need to hit him on the quick slants. I mean, then you'll get a lot of completions. You guys will move down the field and score. Easier said than done.
Yeah.
Right. You know what I mean? Same thing in baseball. It's like if you just swing in the strike zone, and I actually have a funny story about this. So in high school, I had the opportunity. My brother, he was one of the top recruits. He was the number one recruit in the state of Texas, pitcher, 6'7", righty. He threw 97 miles an hour as a 16, 17-year-old.
Did you ever get one in the back?
No, but I had to. I caught his long toss when he would come home from TCU for Christmas break, and the part of long toss that Kirk, the head coach here, he was pitching coach at the time. The program they gave him is that he would stretch it so far that I would stand halfway. My dad would be on one end. We would lob it to each other, lob it to Mitchell, and he would sail it, and then he would work his way in, and then he's crow hopping from 60 feet at the end. So, I mean, you've got 97 on a crow hop, and I'm just trying not to get drilled. You know, I'm catching it like that for sure. But anyway, he was a high recruit coming out of high school. He was like the 14th in the nation or something like that. Super, super talented. His career, he ended up playing at TCU, 4 College World Series appearances, and then went into pro ball, got drafted a few times, and then just had injuries, and so he ended up retiring. But I had this happen in a game. So I was in the dugout his senior year of high school. I was like the manager on the team, mainly just to spend time with him. And the head coach comes over to me. We're playing a really, really high profile game. A lot of scouts in the stands and everything. And he had walked like 5 guys in the game. And he comes over and he's like, man, he's like, I can't get through to him. He's like, just tell your brother to throw strikes. And I can see like he's mad because he's trying to figure out how to throw strikes. Yeah. And he's sitting on the bench, so we're between innings, and I walk on over to him like I normally would. You know, most times I'd leave him alone, but like in this moment, I had a directive from the head coach, and I'm like in that spot. I'm his brother, but I'm also like your student manager, and like you're telling me to now go liaison. And I was like, hey, you know, I like kind of like said it real quick. Like, hey, just throw strikes. I mean, I thought he was going to kill me. I thought he was going to kill me. You know, the point is like it's way easier said than done.
Yes,
and so I think to Mitchell's analogy, they have spent probably an inordinate amount of time creating that list of criteria, so that then they can go and say, okay, we're going to source 900 deals. And he talks in his episode about how they source that, which I thought was fascinating too, that even on the investor side, the amount of research and discovery and outreach that they do to go find these companies out there is fascinating to me. And then from there, you know, how do you cut it from 900 to, he said, about 150 to 175 with the goal of doing maybe 5 or 7 deals a year? That takes an unbelievable amount of discipline, self-awareness, and skill to understand what is outside the strike zone, not just from a discipline standpoint, but really training the eye to be able to see it coming right the second it leaves the hand. That was Ted Williams' thing, is that you can't catch it in the last 10 feet. You've got to see it out of the hand. And their ability, I think that's what makes Lead Edge so successful probably, is that
pattern recognition, right?
There's pattern recognition earlier than most people can recognize that makes them successful.
And discipline to it. Like I said, it'd be so easy to say, well, let's just on this one or this one. And what he also said that I personally really appreciate, I'm assuming people listening appreciate, just give me a fast no. Like, that's fine. Like, I don't, my time, your time, that is, when that second's gone, I'm not getting it back. It's the most precious but perishable asset any of us have, is our time. And that's what he said, as entrepreneurs and as investors, our time. And he said, like, even Sequoia gets a bad rap for saying no fast, but like, I'd rather have a no fast than it's like this long drawn out, like, let's meet 7 times. Let's like, just fast on. That's fine.
Well, I think there's probably a fear or stigma around like the word no. That's hard, you know, to come to terms with. That's actually one of the disciplines that's made us way more successful at sustainment than we've been previously. The sales process has become like we are racing to get them to say no as fast as possible. And the deals we know that are going to be stickiest and that we're going to be able to close and see through are the ones that we can't get them to say no.
Yeah.
You know, but it helps us go facilitate all the other deals in the pipeline when, you know, you're basically trying to figure out, I want you to tell me, no, this is not a fit. And obviously not trying to talk them out of a deal necessarily, but really trying to be honest and move them towards the truth.
Yeah. You know where you can add value, and you're trying to help them see, here's the value you're going to get, or you're not. And that's okay too. You know,
exactly.
Or you're perceived you're not going to get it.
So we've got two clips here from Greg, just closing out that self-awareness, and then we have Doug bringing us home. So we got 3 clips total here. Let's go over to Greg.
Well, putting aside all the traditional evaluation of business and evaluation of industries and all those things, I like executives that have a level of humility slash confidence. They're confident enough to be able to be humble and say, I made a mistake, or I could learn from that, or there's somebody else that's better at this, or there's a competitor doing something better. At Redbox, we actually had humility as one of our called out explicit values. And it really meant that, which is we can learn from anybody, we can admit our mistakes. Sometimes the competitor is better and we should just learn from them. Ultimately, and you have to have confidence to say that out loud.
I love this clip. I want to get your thoughts. One thing I wanted to touch on with the idea of humility, one of the things that we've done in our interview process at Sustainment is we have like, you're just basically like not coachable traits, right? For every role. So there's experience. I need you to, have this kind of background or whatever. And then there's things that you need to excel at in the interview process. But then there's just these intangibles. And one of them is humility. So with every person, and we're a certified B Corp focused on American manufacturing. So that's our vision. And we've got a very mission-driven, veteran-led company that everyone that we bring into the business, you've got to be service-oriented. You've got to be to the mission. And if you're not, I mean, it will tear you down because that's just how we approach the business. But anyway, humility is one of those things. And we've had candidates, and I've been through interview processes where this is the case, where you have candidates who check every box, but they don't have that humility box. And that's the one that we get into those roundtables and you're like, for whatever reason, I can't put them through. Can't put them through because for us, that's a requirement of people we bring into the company. Every employee that we have, needs to cross that box.
Yeah. I mean, it's tough because humility can mean a lot of different things to a lot of different people. And then how do you have confidence, and humility and ego and pride and all these things that, like anything to an extreme become negative, not enough of becomes a problem. And how do you balance those things? And you say it's part of your company values. Well, that's something that if someone doesn't have those values personally, they're not going to pick them up because the company does. Like, oh, your company has those? Okay, I'll start. Like either you are or you're not. Type of deal. You're just saying that's the floor. That's not the ceiling. That's the floor of what we're coming in. And so humility, what I found is, and having worked with thousands of people, the people that are truly humble and confident don't find their identity in their work at all. The ones that I found that like to think they're humble and think they're confident find their identity in what their bank account tells them and what their company title is. The ones that I've seen that just, and some of these people we're listening to and stuff like that are some of those most humble, confident people. And trust me, I've really tried to understand it. I've been like, why is it? Is it because they're so good? Is it because their bank account is so big? Is it because the title, because they're on the front of this magazine? Is it because of the awards they won? Like, what is it? And it's because their identity is grounded in something other than in that. And so, once again, that's oversimplification. I'm just saying, and that's, but we all have things that distract our identity. And I mean, I'm not going to pretend like, but that's where that real confidence comes from, and that humility, that their value is not in the things that people say or do about them. No one wants to say bad things about you, or no one really wants that. But it's about that humility, and that is, it's kind of like how important is humility. It's like how important is oxygen to living. Ego is the one disease that makes everyone sick except for the person that has it. So, and that's different than confidence. And the people that are sharing these thoughts and stuff like that are truly diamonds, in my opinion and my experience.
That's well said. We got one more clip from Greg, and then we'll close this episode out with a clip from Doug.
With our existing investor base now currently, this was an interesting observation back to me, which is I was asking one of them for resources. They had an associate on their team who had some time, and I said, oh, I'll take that person's time. They said this, they said, it's so interesting. I said, what? They said, you're one of our much more experienced entrepreneurs and CEOs, are much more interested in grabbing resources from us whenever you can. The newer CEOs and entrepreneurs tend not to. And I said, why do you think that is? And they said, well, because you recognize that a free resource is phenomenal and you're okay asking for help. Whereas the newer CEOs are worried about asking for help because they're worried about how it will reflect on them, that they don't have it fully together and they can't handle it. And you seem to be open. I said, yeah. I said, wherever I can get free resources, I am game, because this is a tough business to build a business. And if you, venture capitalist, have some resources you're going to give me, keep it coming.
I love his candor.
Yeah. I mean, just real quickly is he was the one who was talking about the confidence and humility. It's not because he's ran Redbox and he's done all this other stuff. It's because he knows that it's the outcome, it's the destination, it's those promises and goals that he's made that he will be measured by. And he's not worried about in the moment how he looks. He's worried about when the moment comes, how is he going to show up? And he's going to do whatever it takes to win. And he leads with that confidence. If I'm going to get to the outcome, it may be messy along the way, but anybody that's investing in me knows that already. This isn't their first rodeo. So I'm going to take research. I'm going to take whatever you can give me to help. I don't care. I don't care what you think, because when the time comes for us to keep those promises and goals, that's what I'm going to be measured against. And that's what I'm going to stay focused on.
So just to recap this, and I love that too, because it really brings you closer to the truth that we all need help, right? Like you don't want to come across as someone that believes they've figured it all out or anything like that. We're all learning. And these are people who have done very, very successful things, honestly, more successful from the light of scaling a business than most entrepreneurs will live in their lifetime.
Yeah,
right? Majority for sure. So this idea of being a lifelong learner, I think, is really crucial. The 3 segments we covered today: defining the valuation trap, learning to exercise capital discipline, and the value of a self-aware founder, entrepreneur, and investor. Let's close it out here with just a reminder from Doug's song. This is kind of funny, but a good reminder about just kind of refusing to over-raise.
Don't over-raise. It's always difficult to raise, period, right? It's always a tremendous amount of time. And for first-time founders, it can take, 6 months, I think, on average sometimes, right? For folks to really get a round done. So you have to pace yourself. But also, there's a side of it, which is that once you are successful, kind of pulling together around investors, it's very tempting to sort of raise a lot more than you need, or in terms that you set a much higher bar for the company than maybe you might be able to meet. I think certainly during the bubble of the zero interest rate sort of boom, maybe 2020, 2021, and so forth, where you had, just hundreds and hundreds of companies end up raising on terms that were really not justified by the fundamentals. And we see it now, right, with all these hundreds of unicorns that are now overvalued and deflating. There is such a thing as getting a bit over your skis that way. So I tell founders, always right size, the amount of capital you're raising for the stage of the company and for what you're about to do next. You were a bit lucky at Duo, or I don't know if lucky is the right word for it, but there's a point every year at which Duo was cash flow positive. And so we had the choice, right, to lean in and raise more capital to accelerate and go faster, or to continue on the trajectory we were at, with the capital we had, and we're raising from customers, right? And so, which is the best kind of capital, right? If there's one thing I tell founders is maintain optionality. That it's very easy to get sort of stuck one way or another, either unable to raise or having raised too much, such that you are in this sort of land of the walking dead. We can talk about more of that later, but there's, like I say, right now we're sort of in a market full of zombie startups. That's as bad a place to be, actually.
It's funny. Zombie startups, Walking Dead. I thought that was a funny way to put it.
It was pretty good.
Yeah. He's soulful too, for what it's worth. Getting to listen to Doug. I know you said that about Brett, but Doug is very soulful, and I really appreciated listening to his interview.
Yeah. His full interview is, he's really very humble, very well spoken, but yeah.
And so he gives us a frank reminder right there. I mean, he uses the vein of, not over raising or refusing to over raise, but in context of his conversation, I hope our listeners got that in some of his clips. he really was talking through, hey, it takes someone who can define the trap, who can exercise the discipline and be self-aware and humble, to not go make that, you said earlier, the small steps. All it takes is one or two pen strokes and small decisions that can really wreak havoc on a company and on the leader. And so that, I just felt like this was a great reminder to encapsulate the episode here.
Yeah, the thing I like about this episode and the next two that are coming up, you've got investors who are giving the money, you've got CEOs who have received the money, and you've got some that have done both. And what you heard from, Mitchell and from Julie, who have predominantly been on the investor side, say about people like Greg and Doug and Brett, is that they are very thoughtful. They want everybody to be able to make money. They don't want to put a weight on the business that they can't lead through or ask their team to be able to lead through. And I've seen how weird and cryptic those conversations get when we're trying to push people, and people are saying, like, why are we setting the goals at this? And they're like, we're never going to hit these. And then you become part of the bad apple club if you kind of say, like, we're never going to hit that. But then we can't say we're not going to, because you can't go to the next board meeting and say, like, hey, we're, and so it just creates this really weird weight. And I talk about clean, clear communication inside of a business. That kind of starts to become really cloudy and kind of awkward and weird. I'm trying to show you how this shows up inside the business after you make some of these decisions, good or bad. The good ones, it's different. It's clean and clear. People are motivated. They're excited. We're attracting. People are preemptive. They're coming to the business, want to give us money. Or it's another quarter's gone by, we missed. Another quarter's gone by, we missed. Like, why would we keep setting up stuff to miss? Well, it's because we have this valuation we have to go hit. And if we say that out loud, everybody in the business becomes, what does this mean? I mean, that's
a way to strike fear.
That's a real truth that's not being spoken about, and we didn't even get into these conversations.
Yeah, I was gonna say that's a whole episode right there.
I mean, that's real.
Yeah, it is real. It's real. I've seen it.
And when you hear it's lonely, that's some of the reason it's lonely, because you know it, but you can't really talk about it.
What's one thing for our listeners, kind of bridging from here to the post-raise side, that you want to kind of set up and prepare them for, to be thinking about?
Yeah, so I hope people are hearing us, there's some tough stuff, but I want them to really hear that this is exciting, and you don't get to have these kind of problems unless you're successful. That's why I call them warning signs of success. You don't get to do these unless you're doing something right. And so live in that, but don't stand on scars or that have been already cut by other people. Learn from these. Go back and listen to this episode. This next episode that we're going to do in 10, I'm really excited about it because it takes us further in the journey. Now we've raised the money. Now what? Kind of, so what? Now what? So that's what I hope people take from today. And I hope that if, they'll go listen to these next episodes and they'll look at the story arc and they'll get something that's valuable to them, that makes a difference to them.
It's a great closing statement. With that, let's climb.
Let's climb. We just pulled back the curtain on what we called the Mirage of capital, the illusion that big money automatically means big success. What we learned is the money multiplies your vision or your mistakes, but raising the money is just the beginning. In our next episode, we explore what happens after the deal is signed, because capital is a transaction, but success is built on the relationship. We'll dive into how founders and investors build trust, communicate through the hard moments, and why this dynamic is more like a mirage than a deal. That's what's waiting for you in episode 10, Beyond the Raise. Let's climb.
Thank you for tuning in to the For You Leaders podcast with Kirk Dando. If this episode helped you think more clearly or act more decisively, that's good. But the journey doesn't stop there. Subscribe for more content on Apple, Spotify, or YouTube, or go to Kirk's website at kirkdando.com to inquire about coaching opportunities. Now think of a friend, family member, or business leader in your life. How could you help normalize their journey today? Share this podcast with them. We hope that this sparks meaningful conversations in your life and that it enables you to become the leader that you aspire to be.